Hi, I'm Aoife Devitt, and welcome to this week's Markets Happy Hour podcast. It is Thursday, October 9th, and I'm delighted to be joined here by a long-term friend of mine in the industry, Ian McKnight. Welcome, Ian. Thanks for being here.
Thanks, Ethan.
Well, we're going to talk today about alarms and false alarms, and I'm looking forward to having a very animated conversation with you, as always. But just let me bring up the slides and we can kick this off. Well, I have called this alarms or false alarms because clearly there are a series of factors coursing through markets right now. And it's very difficult to know if this is cause for alarm or just yet another false alarm. But I do think it's the onus is on us as market commentators and watchers to look for those canaries in the coal mine and call them when we see them. So, as usual in this podcast, we speak about inflation, geopolitics, interest rates, equity markets, and other asset classes. And what we're going to do is our usual vibe check on the economy. Given that Ian is based in London, as I am, we're going to do a bit more of a deep dive into the UK and some of the economic parameters there. And we will then look at equity markets and how they are providing a bit of a rough with the smooth, in that there is both good news and bad news to be read into them. And then finally, we'll look around the world at geopolitics. Just today, we've had a peace deal announced between Israel and Hamas. And we'll ask whether that means anything in particular for markets. Obviously, it means a great deal for the countries involved and peripheral countries. But we'll ask whether it means anything for the direction of assets going forward. So this is Ian. He is a long-time asset management CIO. He is the Chief Investment Officer of Tontine Trust, a Senior Advisor of Cartwright, Hineni Capital and Giant Shoulders Capital. He has a number of other roles, including a charity board and on the investment committee of the University of Warwick. And I knew him as Chief Investment Officer at Royal Mail. So once again, Ian, thanks for being here.
Thank you very much for having me.
Well, let's kick off with the vibe check on the economy. And this is where we usually discuss inflation. And a few weeks ago, we asked whether the economy was better than we thought. And this was the US economy only. I think it's safe to say that the UK economy is not better than we think. And the pointers I looked at there were really the effect of tariffs. It had been increasing revenue in the US. Immigration had been having the effect that it was supposed to have in terms of the labor force. And there was then a sense that GDP could actually be stronger than we had thought. It was expanding at 3.3% pace, which puts it ahead of in the UK. And I suppose I'd love to pass this back to you now in terms of your read on the US economy. We know that inflation is somewhat in check. The markets are screaming ahead to new highs, but there are creeping evidence of weakness in the economy there. So what is your thoughts, first of all, on whether the US economy is as strong as we think?
To my eye, it's always watch the jobs numbers and how they're doing and how it's percolating through the real economy. I characterize, in my head at least, the difference between the UK and the US. They're both spending too much money. They've both got chronic debt issues, and they're both spending lots, but one is spending it for a home run, which is America. And if they connect, then the G will get them out of jail, right? So they're going for growth. In the UK, which we'll come on to, I think they're doing the opposite of that. So at least there's the hope that the home run connects. The issue is, of course, are the shorter term GDP numbers that you look at somewhat of a mirage, and that holds everywhere, right? It's too short to say really. So what fundamentalists doing, what's capex spending looking like? How are people really looking at that country as a relatively attractive place, both from a long-term place to do business, set up business, float the business, and also the taxation environment for all of the above. So I think with the US, there's hope, but I think there's the job market's the one to watch there as to how that's doing and sentiment. But certainly sentiment wise, I was just over a few weeks ago and it was so much better sentiment than I felt last year from pretty much everybody I spoke to from lots of walks of life. Read into that what you will, it's anecdotal. But I think that's the big difference. It's a sort of watch and see, but it's just generally speaking, what does the economy mean? You're just looking for growth, you're looking for underlying productivity. Are the productivity gains there? Is the AI investment going to lead to those in future or not? What are the energy policies of these countries looking like? Are they going to be able to attract and retain the capital, the people, the growth? there's so many factors that could blow it up or have it succeed. But America's probably got more of the ones where you'd hope it might succeed more.
Based on growth.
Generally, the equity markets are clearly toppy, they're skewed. Um, the multiples of earnings are vast, and terming stuff out in a vastly moving economy where AI might replace a lot of these industries or hit them to meaningful degrees, isn't really the time you would rationally term out your multiples. So there's a big open question as to whether there's a monetary premium unwind, not least because of the debasement argument of dollar and sterling. And I think it's an hairy time to be investing in shares, especially, but you can apply the same arguments to bonds, of course.
Yeah, we do. And let's break it down a little bit. So I think you're right to
Mm.
say that there is a difference in expectation and that the different growth trajectory, probably as underpinned by tech and the positive story there, is really the differentiator. Let's just go straight into some of the weeds here in terms of inflation. I had anecdotal evidence last week based on my conversation in San Francisco that there is quite a bit of concern for the consumer around inflation. But at a broad level, it seems based on break evens and swap rates that actually expectations are down and they're not in the kind of red zone or the danger zone. So the Fed has done its job in that respect. It can be reasonably relaxed. And it doesn't seem that inflation, at least, is become a big issue in the US. I've got some other slides that will be a different story in the UK. I think the interesting point here, doesn't I'd love to get your feedback on this, is, what are the equity markets actually telling us and why are they at these highs? And there's one, on the one hand, there's a strong tech trajectory. And on the other hand, there's been this strong free cash flow yield. There's been the fact that margins are high and are being supported. And companies are generally buoyant on their earnings because they have pricing power, because they've secured their margins. That's a very different story in the rest of the world, but certainly in the US for the margin side, it's strong. I think the cash flow can be even higher in the rest of the
Mm.
world. So all of this kind of presupposes ongoing inflation, actually, because if companies are to protect their margins, they would protect their pricing power. So all of this kind of suggests it's probably not that great for the consumer that the companies are doing this well. So I do think that's kind of an interesting twist on equity markets. I mean, we've mentioned before that the equity markets are at an all-time high. They've had over 29 highs in the S&P year to date. Do you think on the equity markets are justified these valuations in the US, or I think you suggested they were not?
No, I don't. But I think that the irrationality is neither here nor there in it. Would I rush in myself? Well, no. But people do. And there's a huge retail support in the US, patriotically, I think, as well, for stocks. Could you just flip to the back to the last slide? Because I think that's worth looking at in a little bit of detail. If you look after 2020 and you add the whole Russian invasion of Ukraine, crisis, right? And what happened there is fascinating to me, not in a good way, sorry, fascinating academically, in that you had the massive fertilizer stock out of Ukraine, hammer yields, crop yields, food, and hit energy with the gas crisis and the fact I think the last administration had sort of not prioritized drill, baby, drill, or whatever. There was an energy problem and a food problem. And what you also have in the US is, of course, a very high it's actually average globally, but it's a pretty well-known poor poverty gap. So you've got the wealth gap of very wealthy versus the poorest. And unfortunately, because of that crop yield failure, food and energy, the two things everybody needs, were absolutely brutalized. And so you saw that inflation carried by those sectors, creating more wealth disparity than we've seen. And of course, as people hid out in financial assets and you had wealth in those, you got even richer, multiple times more. So that societally is clearly unsustainable. And I don't know the degree to which that creates political pressures in the US to target certain areas and not versus UK. But it's worth noting because it's such a big, steep thing there. And that came off when, of course, the supply chain problems post-COVID were sorted to material degrees and backup plans put in place and proper energy policy, at least in the US, was restored. So to the degree that that's showing it coming down and that's good, Yeah, I've a long-standing view that any inflation target's bad, right? Why is inflation a good thing? I've never had a good reason why we've got a diet of low inflation is good. No inflation's better because I want the value of my day's work stored in cash to not lose me value, and it does because of this. So on the next slide, so that was the inflation side. So yeah, it's in long-term average sort of so what? You've got to pair that against not just the fiscal side of redistribution, where governments decide who to take from and who to give to, but the monetary side, which is more broad-based and societally or socially unfair by its very definition, as we just saw, hammers the poorest longest. The cash flow yield points more to a broader question on quality companies, as a style. So what it doesn't show here is the balance sheets, and I think corporate debt is probably fine for the most part in corporate America, but when are they terming out? What do their term out look like? Certainly at a national level, we know there's a trillions wall coming that's going to be hopefully propped up by this tokenized market to keep perhaps Chinese state interference in the treasury market at bay. But on the corporate side, it's going to be very balance sheet dependent, pointing to a big differentiation between well-managed companies and not.
Really interesting. And we will get to that debt question in a little bit. I think moving to the UK now, we'll just do a little bit deeper dive than we usually do in the UK. You've spoken about growth and debt problems and inflation. And here
Mm.
we are in the UK, which I've seen described as the new net zero, where the growth is trending towards zero. We do have UK debt as the blue line. It's not as high as it has been, but it's certainly high relative to history. And then
Mm.
inflation remains very high in the UK. We know just south of 4%, two reads one after another of 3.8%. Looking at the headlines, we're hearing about a vicious cycle of soaring food prices. You spoke about energy, food and energy here, increased reliance on gas imports as domestic supply falls. And then we have all of the other headlines of economic malaise with sales and rental listings falling, focus on the budget, uncertainty growing. And then just to see where the food inflation does sit, it really is an outlier relative to other countries in Europe, in this case, as well as Canada and the US. So, in terms of, we have this kind of cocktail of low growth, high inflation, this classic stagflationary definition. Um,
Mm.
do you see any positive indications in the UK? Do you see any kind of escape route for some of this decline?
It's pretty miserable, I would say, frankly. And would you set up a business in the UK today? It's the lack of policy clarity, and your exit into the local market might not be as good as you want. That you're uncertain as to where you're going to get walloped with tax next. It's not fundamentally an attractive place for people to flow capital into outside of certain sectors where there's natural demand for their goods and services here. And it's a huge market, let's not forget. So we're always full of hope, but I think until the government gets its spending under control, that we're just going to face systemic problems. The things you raised here again goes back to the food and energy prices, fundamentally for most people. But what I referred to earlier is also present here. It's the jobs numbers and unemployment, certainly that I saw last tick was going up. And so we've already got a bit of a demographic issue with off-balance sheet pensions and so on, and fewer workforce going into it. And inflation doesn't help any of this, of course, it just multiplies the problem. So I'm struggling, honestly, to give you bright sparks of good news because I feel policy's been set a little bit firefighting, kicking the can down the road and short-term win for long-term pain. And I hope that might change. We've got a budget coming up and we might see sparks of hope, but it's sort of in that classic bumping along, has it hit the bottom yet? Certainly, relative value wise, you could argue that the small and mid cap stocks, which ticked up lately, might be relatively good value if there's fundamentally good businesses there in good sectors that are embracing the modern economy a little bit better than others, then perhaps there's pockets you can pick off. But generally speaking, it's a tough market to sell as attractive right now, sadly.
And I suppose the interesting point, I've used a lot of comparative charts. It's always a kind of question of compared to what. And I think, I'll tell a
Mm.
story about Italy in a second, but, what we've seen over the channel, well, it's sort of compared, we're not alone in having a certain amount of chaos and confusion. I'd say at least in the UK, the prime minister is stable for now. We've seen in the US, we've seen in France a revolving door of prime ministers. I think there have been five prime ministers since 2022. This has been, we can see that that's already been reflected in markets, the extreme uncertainty there, the same problems as you mentioned, an inability to cut spending. And I think, the fact that the euro area is showing some upside is only probably, you can see employment there has been coming down, the output per worker in terms of productivity slightly ticking up. That's a good sign. But I think when a country like France, just to go back to that chart, makes Italy look relatively stable, Italy that has had 69 governments since the end of World War II, because they've had the same prime minister for 3 years, it's again a question of relative attractiveness.
France is a bit of an outlier, I think, in you. But if you compare it with Spain and Greece, it's very good. So its debt to GDP and per capita look terrible. And so they've got a chronic spending problem. They've also got a cultural issue of being vastly more sort of socialist leaning. There's a great, the welfare state and people expecting government to kind of redistribute for them. But in Spain, by compare, they got their debt under control and are growing, remarkably well. So notwithstanding the absolute levels, you can sort of see the relativities between those two as understandable. Greece I always find remarkable. This is a country that defaulted 5 times in the last century and change. And then in living memory, very recently, of course, had massive restructuring issues and yet was tight to France and the UK. I mean, it's remarkable. A dollar, euro cost average, the German economy in much better shape, but struggling in its own way, actually just dragging the yields for everybody else down. If you did the net, adding it all up, kind of doesn't make sense to me, but it is what it is. So I'd say there's some way north to go on all of those, frankly, but it's a bit gloomy, isn't it, out there?
I guess the reason I bring it up is because clearly, with the US markets where they are, there is a desire to take some profit, to diversify, to try not
Mm,
to be too exposed to those top 10 tech names. Because,
yeah.
we've kind of exhausted almost the discussion around the AI bubble at the moment, because we certainly know that such is the cash pile, such is the long-term investment, such are the powers that be and the wills that be. We're not probably going to see an AI bubble bursting just yet. But I think that because of this factor, that's why we look to non-US markets to see, well, where are the green shoots there? Where is the kind of the lagged uptick in growth? And I'd say in Europe, it's a fairly mixed picture, as you've just seen. Some slides here just to kind of touch on the kind of the phenomenon around AI and this bubble, and if such as it is, and some of the knock-on effects. You've spoken about power, energy being a key criteria to economic health of any country. I think the interesting point here, there's been a large drive to attract data centers, clearly fundamentally important infrastructure investment. If any country in Europe is to get on this AI bandwagon, they need to have this type of infrastructure in place. I think the knock-on effect, and this is actually a headline from the US around AI data centers, how they can send power bills soaring in the surrounding area, such as their thirst for power. So we haven't really squared that circle yet in terms of the demand there. Clearly, electricity demand through the roof, as well as this is going to affect energy and clean energy alike. But they have not yet seen, really, energy has not yet seen the uptick in demand from a stock price point of view, that we would have expected. Thoughts from you on this key dynamic, I suppose, in terms of.
You've got a regulated market, right? So the stocks are never going to blow the lights out. So a lot of the interesting areas you might look at, and but to point to the UK specifically. So a lot of I think the only offshore wind farm that showed its books is basically a subsidy arb. It was losing money. So they're not. You wouldn't rush into this, in my opinion. But there's a lot of exciting private market adventures into battery storage, transmission, hydrogen usage to store power. And around Cambridge specifically, and there's a great deal of wonderful work going on there with fellow Accringtonian Ilias Khan is involved in a great a great graphic chip company, I believe. So there's some remarkably cool stuff going on the chip development and tech IP side, certainly out of the north of London, Hertfordshire way, that I think is attractive. How can you access that is another question. And the AI storage, generally the data center. I don't think we're lagging in data centers. We've probably got a lot of them. But it's a story playing out all over the world.
Exactly. And I think what we can see is it's becoming weaponized as well, just as rare earth
Brilliant.
minerals are critical to the inputs there. If President Trump can play the tariff game, so can she. And I think we can see this potential of rare earth curbs that would send shockwaves through the supply chain there. So
You've
clearly,
already seen it, right? A lot of private money in the US is going into mining again. You've had the whole, people seem to forget the discussions that took place on carving up the natural resources of the Ukraine. We know the story on East and West Africa and who's been carving those resource supplies exclusivity up. The Venezuela issue as well, right now. There's an angle there, isn't there? So securing rare earth and energy commodities is the story, right? I think.
and you would see then the energy sector as a good kind of complementary sector to gain exposure to this wave, would you?
Yeah, for sure. Because notwithstanding the world wishing to give up on dirty sources of energy, that is just not going to happen, even with the best will in the world, because we need far too much of it far too quickly. The fact we're even having discussions with Russia, the US, on who's carving up Alaska is remarkable. And let's not forget, by the way, that in recent memory, there's a huge swell of natural resources. Not only are we on an island floating on coal here in the UK, which of course is non grata at the moment, but the Falkland Islands, which we still own last check, has an absolute field full underneath in its territorial waters that is potentially a great source of wealth for somebody with the political will to extract it.
I think it's an interesting chart, this one below. When you think about it, this is a chart showing the coal ETF and the clean energy ETF, and it only runs back a year. And
Mm,
what it looks like a U-shaped recovery here, a V-shaped recovery, because it did dip precipitously in around the time of Liberation Day in April, like other stocks. And certainly the Trump administration was not kind to this particular ETF, the clean energy story. We can see that it was battered relative to coal at the beginning. But now it's
mm.
actually staged a comeback. It's back to above where it was before last year's election. And that in itself probably tells us about this fundamental driver. So maybe it's
Well, it
kind of above
will. I
politics.
mean, while you're making money on your coal side and you're diversifying into clean energy, which all profit, it's much more attractive to a big dirty energy producer to diversify and burnish their green credentials alongside a hugely profitable business, and they'll invest more in it. So of course it's going to do well as well, right? But I would suggest, when the chips go down, they kind of get thrown out first because they're not going to make as much easy money. And that's just ruthless capitalism speaking, right? Because um, it's what's cause and effect of that. Is it because it's a great thing? Well, actually, none of that is for money making. It's because people think it's the right thing to do for the planet. And so you've got this constant tension between what people want to do morally and what they can afford to do financially.
Well, fantastic discussion there. And let's move on to look at some of those other alarm bells that we mentioned. We're not going to talk about the AI bubble, as we said. We'll leave that to another day. On the debt side, we've already spoken about debt, and we know that debt is
Mm.
rising everywhere. It has been rising at a household level, non-financial corporates, certainly governments, and that's not just a U.S. phenomenon. The first slide that's slightly blurred, but it goes back to '08, and then we know it has been a global problem as well, and that equally bond spreads have been quite subdued. And that factor of bond spreads being subdued and the suggestion that there is kind of quite an optimism among bond investors around the credit worthiness of the high yield and investment grade segment is actually causing some nerves at this point, suggestion that could things actually be this good? The nerves are being caused on the corporate side. We can see that on the government side, we still have 30-year yields surging. suggesting that the confidence in government is something different entirely. As a long-term CIO and I think expert in the fixed income space, what do you make of these two kind of parallel stories, which are sort of sending mixed messages?
Nominals are normalized and credit spreads are tight. We're due a good recession, as they say. And interestingly, once everything's tanked, that's when the real money gets made.
And your sense as to why the bond investors are so positive and driving yields down, yet on their
I
other hand have no confidence in the long term?
honestly have no idea. Probably insurance, supply and demand, people hiding out. It might be they've had a diet of short-term money not making it too much, but they're nervous about longer term and don't want it to back up further. I think there's a sentiment view that, we've more to go. So let's clip it for my time horizon. I'm happy to keep that percentage, accepting I want optionality on the upside, being to see the swaption rate.
Mm. And
But
then
go on.
no, no. Then the other issue is on the private debt market. We've spoken of this before. It seems to be getting more and more airtime. The First Brands bankruptcy filing debacle. I think a little bit because of this trade claims area, which had been seen as relatively, I say, bulletproof and certainly seen as a safe, especially when the counterparties were Walmart and other reputable, credit-worthy counterparties. The fact that there seems to have been a vanishing of around 2 billion of creditor claims seems to suggest certainly a murkiness in the accounts at best,
Mm.
as well as many other high profile institutions being kind of affected by this. So I suppose that the question is alarm bells or or not, false alarm, whether this is a sign of some deeper cracks in the 3 trillion plus private credit market, a sign certainly of I'd say less than perfect due diligence and less than accurate.
It's easy to get distracted with a shiny, such a big blow up. Someone once said to me, I always remember this, in the US, bankruptcy is not necessarily that bad a thing, right? Because you can restructure, refi, and work your way through and come out in some sort of condition. And I think, notwithstanding that comment, we are due. We haven't had a proper period of distress for quite a while because the last few sell-offs were bailout, and you've a generation of people coming through who've never seen a proper recession yet because the government always sets in, it always bounces back, even big sell-offs. We saw the war, the wars that have broken out, geez, and somebody, sorry, the Ukraine one's a good example. It tanked, and you're like, okay, this might be the sell-off we sort of. Oh no, it bounced right back. Like it hadn't even been started, let alone halfway through, let alone the beginning of the end of the. And it's just, oh, it's just another major disaster. It'll be fine. And I found that remarkable at the time and find it remarkable today. So what will it take to break the markets right now? Because I'm pretty certain we're due.
Well, I mean, suppose we could look at the default rates. They are trending upwards. If the
Mm.
2025 default rate through August is the same as that the entire year 24, that at least suggests it's trending at a third higher. So that's something, I suppose. And there's a lot more money exposed to private credit today.
There
Um,
was a sea of it, wasn't there? There was an absolute sea of money chasing private credit, and a lot of it was going into vanilla stuff, keeping potentially the rates you're getting paid for implicit implied default rates as not as attractive as it might be. But I think people get wooed in by the numbers and the recent memory track record and think this is a great idea. But I'd be very selective personally in exactly what sort of credit you're getting into.
And then the final alarm bell is really around other assets. And this comes from gold and the fact that, as long as you and I have been investing, gold has been seen as a hedge, a non-correlated asset, or a hedge against a flight to safety or currency debasement,
Yeah.
or just lack of confidence in fiscal policy. Everyone's been talking about it blasting through 4,000 an ounce. We can see Bitcoin has been doing something similar. I think an interesting chart is to see how Bitcoin has actually been less erratic, has actually got less volatile, perhaps less predictable, nowhere
It's
close to
been
gold.
institutionalized. That's the beauty of Bitcoin. And to the extent it's replacing gold, people have a concept of gold in that they buy their wedding rings with it or whatnot. And therefore, you could argue, is it pegged or not, or do they just keep getting more and more expensive? Whereas Bitcoin doesn't suffer from that tangible side. It doesn't matter how much it is, right? It is by definition a store of value. So if I do a day's work and I put it into Bitcoin, I want my day's work to still be able to buy me stuff at the end. You can't say that about dollars. You can't say that about fiat currency. And gold, historically, I've been taking this, has now got a digital contender for its crown, for its Bitcoin crown, as it were. And I just think it's a remarkable story to watch. And the more that volatility stays down, and the longer that goes on, the more confidence people will have, and it self-fulfills, you see.
Exactly.
So I think we're seeing the dawn of the Bitcoin age, and it's all very linked to the future digital economy, of course, which is going to decimate settlement banking and many other besides, because it's it's the future, and certainly the UK, we're way behind the US in terms of adoption, understanding. What is money? There's a great article on Cartwright's website. I'll flag to you here. Have a look. Most people you ask don't know and cannot answer that credibly, remarkably.
Well,
And
we'll put a link to that. But I think the interesting point,
yeah,
if Bitcoin is a contender for gold's crown, or however we phrase it, we certainly gold is not feeling it yet. There seems to be boundless demand for gold at the moment. Whether that's
yeah.
coming from the Chinese demand or different technical factors, there are other central banks which may be kind of reaching the end of their demand cycle. It's I think whatever it certainly indicates a strong demand for diversified returning assets, higher
I think
returning
that
assets.
carries on, frankly. I think this story just plays and plays, and it remains to be seen what triggers other things to make that more stark in a real sense. But it's kind of where a lot of people are hiding out.
So I
And
don't see the demand for gold as necessarily an alarm, being wrong
no,
because
not at all. Well,
yeah,
it's an alarm for the state of fiat currency.
exactly.
But it's been doing this for years and focused upon. I think Bitcoin has brought a lens onto gold as well that historically hasn't been done there. A lot of private wealth has made good protection over the years, having it in the way the institutional market has perhaps failed to do.
Well, my final point, having shown the disclaimer there, is that something we didn't have slides for because it's really breaking news around the peace deal in Israel
Wonderful.
and for Gaza. I say cautious optimism is facing it right now.
Yes.
Um, it's obviously a human triumph if that's the case. Not something we generally would. It's not almost appropriate to translate it to markets right away. But given we are here discussing markets, I think we can only say that's a positive thing for geopolitics and for world markets as well as world peace. Any thoughts as to how this will be
I
digested?
really, really hope so. It would have been a very long time coming, and it's cost an awful lot of lives and misery and horror. Let's just hope that it does. In terms of its impact on markets, you might look at stability of oil supply and travel and all of these things to the region that might be supportive. But it's a successful area anyway, outside of Gaza and Israel's issues. But we still got and the focus that this gets for whatever reason, we've still got a huge raging conflict losing many, many lives every day in the Ukraine. So Russian and Ukrainian lives lost every day. We've still got a military junta in Myanmar and and horrific atrocities going on throughout Africa. I think the market impact of this one might be more marked to market impact if we were to stop the Ukraine one. But I think this one's clearly close to a lot of people's personal hearts. They might have friends or relatives in the region, or just have a very personal interest in it for whatever reason. And it's more linked, I think, to the oil complex than anything else. Because remember, you had America just dropped big bombs on Iran, and that's just gone very quiet. What's going on there? I don't know. Do you? So it's sadly something that will just keep raging for a great deal of time, and I hope it ends peacefully with families reunited, as we all pray for.
You and me both. And of course, it has bled into national politics as well. And maybe we'll remove
Yeah,
one more distraction. And then it's certainly here in the UK and allow the UK government to focus on its priorities around the economy. Well, thank
quite
you very
right,
much,
Sophie.
Ian, for
Thank
joining me
you.
here. Fantastic conversation. Thank you for joining
It's
the Markets Happy Hour podcast.
been a pleasure. God bless. Bye bye.